Hello, this is Chew Dog Charts. Today we're going to talk about gold. This is a chart going back to 1950 showing the US dollar purchasing power as measured by gold. And as you can see, in the 1950s and 1960s, the purchasing power of the US dollar was reasonable. However, when in 1971 the US government went off of the gold standard, the purchasing power of the US dollar dropped precipitously down to a low in 1980 before coming back in, say, the mid 80s and maybe even into the early 2000s. But subsequent to the 2000 tech bubble, the purchasing power of the US dollar has trended off down to where it is today, a relative insignificant amount compared to what it was back in the 1970s. Gold has been money, not only a commodity, but real money. For over 2,000 years of human history, not only has gold been the only form of money to survive this period of time, it's also a form of money that essentially was used in all four corners of the globe. It was, or has been, the singular best store of value during this period of time. In 2008, the financial crisis, which was marked by the failures of Bear Stearns and Lehman Brothers, both attributed to the excessive debt levels in the U.S. market, the problem was solved when the U.S. government, as well as the Federal Reserve, resorted to the extraordinary measures of inflating the financial system. At that time, there were only about 15 major U.S. banks in the U.S., but today, after years of consolidation, there are about 5 banks. These banks are referred to as too big to fail. Where have we heard that before? In my opinion, with the concentration of the financial power into only a handful of banks, the systematic risk has only increased. In 2008, the U.S. government debt was about 10 trillion. Recently, we just crossed over the 20 trillion level. But the problem's bigger than that. It's just not the U.S. alone. The same explosion of debt has also occurred in Europe, China, and Japan. So the risk that the debt poses to the global financial system seems to be enormous and growing. This is a quick chart of the price of gold that goes all the way back to around January of 1915, where the price was about $467.95 per ounce, peaking in December of 1979, January 1980, somewhere above $2,000 per ounce, all the way into today, where we're trending in the mid $1,200, $1,300 per ounce range. The chart we're looking at right now is the 20-year monthly chart on the Spider Gold ETF GLD using real-time stock quotes. As you can see by the chart, the price of gold, at least through the ETF, bottomed in early 2016, perhaps late 2015, made a move into mid 2016, came back down, and we seem to be going sideways. What's important to look at here is the 20 EMA and the 50 EMA are beginning to move more parallel. Some of the reasons for the increase in gold include the decline of the US dollar, When you take a look at it, it's been falling probably since the recent presidential election, since the dollar and gold tend to have an inverse relationship in investors in response to seeing their cash decline in value relative to other currencies often seek out the safety of gold. It's essentially a finite resource and has been used, as I said, as a form of currency for centuries. Taking a closer look at GLD, we move down to the MACD and we see that similar to the price, the MACD has improved, but the improvement probably started here in, say, early 2014 and moved up to the zero line here in early 2017. And I think this is important is because once the MACD trends toward the zero line, that's when, if you're above it, prices can move and can move quickly. And if it dips below, it can go the other direction as quickly. The MACD histogram also shows that essentially we are trending near the zero line, so it's coincident with the MACD. Taking a look at the relative strength index, it's at the 50 line, which essentially is the same indication as well as the stochastic. What I'd like to see in the stochastic is perhaps a move down and a better consolidation near the midline. They're at the 50 level. Volumes trended up since 2016 after dropping quite a bit after the 2008 crisis. Into the Williams shows much the same, and like the stochastic, I'd like to see this move down into the 50 line as well. Going back up to the price chart, what I'm seeing is after a relatively long period of time of consolidation, and with the 20 EMA moving up, approaching the 50 EMA, and here in the future possibly moving above, there might be a good argument to say that gold might be a pretty good commodity to purchase, perhaps the ETF. However, it's just not the physical gold that we need to be taking a look at. I think some of the individual gold mining stocks could also be primed for a considerable gain here in the future, since gold prices play a critical role in determining their profit margins. During the second quarter, many of the largest gold producers reported an average sale price for gold of about $1,250 an ounce. That's when gold was hitting a low of around $1,219 an ounce and maybe as high as $1,293 an ounce again during the second quarter. However, during the third quarter, gold has taken a new leg up. Despite that low at $1,212 an ounce in early July, gold closed as high as $1,348 an ounce in early September. So what that means is we're probably looking at an increase of, say, $10 to perhaps $30 an ounce in the average selling price for gold during the third quarter. So even though the prices of the individual gold miners hasn't necessarily moved that much, we've seen some interest in them, whereas some of them have had some recent upgrades. Newmont Mining had 4 analysts increase their earnings per share estimates out of a total of 13 analysts. Goldcorp, 3 analysts increased their earnings per shares out of the total 12 analysts. Barrick Gold, there were 2 analysts that increased their earnings per estimates out of 15, and then Yamana Gold, 1 analyst increased his earnings per estimate out of a total of 8 analysts following that company. So rather than take a look at all of those, I'm just going to simply pick one of these gold stocks and let's go through it. What you're looking at here is the 20-year monthly Barrick Gold corporate common stock. Symbol is ABX. And as we take a look over here in 2017, the price chart looks very similar to the ETF, the gold ETF, whereas the 20 EMA right here is closing in on the 50 EMA. Not quite going parallel, but certainly a large improvement from perhaps 2 years ago. If we take a look down here at the MACD, this is what I find interesting. I think you know that I like the MACD. It essentially has shown improvement from late 2013 all the way up to now. To me, that shows a fairly decent rate of strengthening where we're now at the zero line. The fast line seems to be wanting to cross through the slow line, but it's so shallow that I don't think that's going to really make all that much of a difference here. I would like to see a little bit more consolidation. That is showing here in the MACD histogram, where we're going to go slightly negative here now and probably for perhaps a few more months here until we get further indications out. The relative strength also trending along the midline here at 50, a slight downward trend, but I think the consolidation perhaps is going to be coming in this level here, so I don't think there's a lot of downside further. The stochastic certainly has shown a decrease coming through here in the last, say, this has been probably a year and a half, and I'm going to be looking for this to perhaps turn and consolidate someplace in this level here. We're just going to have to wait to see. The volume, though, is also heading down. Now, I like this in the sense that, to me, it means that there are simply fewer sellers. Yes, there's fewer buyers, but being that we're consolidating, I'd rather see this consolidate down, showing me that there are fewer sellers. The Williams is showing pretty much the same. Now, if we went through some of the other gold stocks, I think that they all have similar indications in all the oscillators, as well as what the price chart shows. So for me, for Barrick Gold Corporation, I'm going to wait a little bit further. Again, for disclosure purposes, I do not own this. If I do, you'll be the first to hear. So I want to see this consolidate a little bit further. We're seeing the higher highs, or actually the lower highs, in a declining trend, and we see that we have the lows are moving up. We're getting to a pinch point, and I like to see a pinch point with the improvement in the other oscillators, such as the MACD, because if we do finally get to a pinch point and that MACD holds above the zero line level, maybe some consolidation here, there is a strong possibility that we might have a pop in the price. But we still need a little bit more data to come through, price data that is. Let's just trend a little bit further here. And I don't mind the sideways trading. And let's just see what some of the news brings. That's Chew Dog Charts. Thank you for being here.